Rates, the 10-year bond, y'all are still struggling with this. First of all, you ignore that 0.57%. You'll never use that ever for anything. But what is this right here? Is that 26 basis points, 2.6 basis points, 0.26 basis points? What is that? 2.6. So bonds were up slightly today in price. And on paper one, I'd be really precise. So bond prices were up slightly today as the yield on the 10-year treasury fell 2.6 basis points. Make it real clear whether you're talking about price or yields. That's where students get, what y'all did. I don't think a single person in last week's class, well, there might have been one or two, but the overwhelming majority of the class really struggled with that. First of all, it wasn't clear whether treasury prices were up or treasury yields were up. So students would say treasuries were up as the yield was 2.6 basis. I mean, it just didn't make sense. So you want to be really, really, really precise. Bonds were up somewhat today, and even then, bond prices were up somewhat today as the yield from the 10-year treasury fell 2.6 basis points. What's the last thing I need? To close at 4.54%. So in paper one, makes it where prices in there, and those two are going to opposite direction. If yields fell, the prices went up. If yields rose, the price fell. And how do I know to say up significantly or not? Remember, 6.5 is that 1 sigma, 1 standard deviation. So 6.5 is somewhat of that break point when you start using bigger words. Get used to talking bonds. This last week, the 10-year treasury yield was up 1.5 basis points. So essentially a flat week bonds. Last Wednesday, we had a GDP number. No, last Wednesday, you had the Fed meeting. What did the Fed do last Wednesday? No change. Well, yeah, the jobs report this week, but the Fed didn't change rates. Now, I wasn't paying attention on Wednesday because I was like all over the place blessing this class, but supposedly the Fed came out with a statement that the market took really negatively, sold off, and then Powell said, no, we were just adding it, wordsmithing it. We didn't really say that, and the market came back a little bit. Then on Thursday, we got a GDP forecast, which came in slightly below. And then Friday, we got the inflation news. That inflation report on Friday, everything was exactly in line with expectations. And yet the stock market still sold off. So that one's kind of hard to figure out. Today, we got an ISM that was really, really strong. You might talk about the ISM in your paper one. If you mention the ISM, we'll talk about that more. But today's ISM was pretty decent. The first time it's been over 50 in 26 months. So the ISM is the reason we like the ISM so much. Now there's two of them, or there's several of them. Actually, it gets kind of manufacturing. Why do we like the ISM? Well, first of all, it's forward looking. It's a survey. And they say over the 6 months, next 6 months, what do you expect? So that's pretty good because you're asking purchasing managers, does the future look good? So it's not a historical number, it's a forecast of the next 6 months. So that's somewhat good. It does have a high correlation to future economic growth. Now let's say you really want to understand what are the most important economic factors out there. How would you do that? Where would you think you could go? You're to ask the economists, what are the 11 most important economic factors for forecasting the economy? Where would you go to find that in one number? Maybe y'all know this. Have you heard of this? LEI? Who's heard of LEI, leading economic indicators? Did y'all talk about that in your macroeconomic class? So the Conference Board, which also does the ISM, they have these leading economic indicators, which the greatest economists in the world, they say these are the indicators that best predict where the economy is going next. And the ISM is part of that. And it's been pretty negative here recently. So here's the components. The index in December was actually positive for the first time in quite a while. The US stock market, y'all think about that. The stock market as a predictor of what the economy is going to do next. That makes sense. What is a stock? It's the present value of all these future earnings. So interest rate spread between the 10 and the Fed funds rate. We talked about that, a yield curve steep or flat. That's an indicator. Consumer expectations. There's the ISM. You notice which ISM it is. It's ISM new orders. So if you want to talk about the ISM, you probably want to specifically talk about new orders. That's the most important component. Building permits, weekly hours in manufacturing new orders, manufacturing, see how manufacturing gets in there. So you might ask the question, why is manufacturing so important to predicting our economy if our economy is 80% service, but manufacturing still drives these numbers? Now, those are the leading economic indicators. There's two other groups, but we have leading, we have coincident, and we have lagging. So coincident are those that are responding as the economy is going. So it tells you where you are, and lagging tells you where you've been. What do you think the employment report is? Leading, coincident, or lagging? The report you get on Friday. Yeah, it's a lagging one. Why? Because when the economy slows down, employers don't cut people that fast. They kind of hang on to them, then they slowly cut them. And then once the economy starts recovering, that's essentially unemployment's at its worst. And you can somewhat see that. If you look at the unemployment rate, you notice recession in the gray, then what happens? Unemployment peaks. Recession, unemployment peaks. Recession. So you see how that's a lagging. It's telling you where you've been. Pretty consistent lagging, isn't it? It always peaks after the recession. So you're actually looking at something that's somewhat backwards looking. But if you really want to understand how economics drives markets and economies, the LEI is a really good place to go because the economists, they say those are the ones that are the best. That's why I bring up the ISM. The ISM came in strong today, so that someone indicates we should have a good economy next 6 months. But you have other factors in there. The stock market's been fairly decent this year, even though it sold off today. So it is one of the LEI. So it has an importance there even today. They don't do the ISM service. The ISM service comes out, I think, Wednesday or Thursday. The market tends to ignore that. It tends to ignore the ISM as well. Today came in strong, and yet the market sold off because what Trump said was more important than ISM. The ISM can be pretty material, I think more on the downside. It's most material when it misses expectations, especially on the downside. They're expecting 48 and comes in at 44. That's when the ISM can really move markets because people are shocked. But if you want to talk about the ISM, we'll talk about this more in your paper. How do you bring it into the paper? Because you do have to set it up somewhat because your boss isn't asking you to talk about the ISM. So you have to talk about the ISM in the paper as additional information to give more context to what's going on in markets. Because it comes out this week. It came out on Monday this week. It normally comes out on Wednesday, but because we're a little bit off with February starting on a Monday. All right. Okay, so let's talk. All right. So if someone comes to you with $500,000 and says, "Can you help me?" How might you start them off? First of all, what did they want to do? They want to build a what? Portfolio, a collection of assets for some future purpose. So you might ask them, how many questions? Three. First one would be, why are you investing? Probably for retirement, but you don't know. And what's the biggest thing there? Your horizon. When do you need the money? You're going to need it next week or in 40 years. All right. Second question, in what can you invest? All right. That comes down to asset classes and sub-asset classes that we're going to spend our time in. Your last question, how are we going to implement this thing? Are you going to do it yourself? Do we need a brokerage? Are you going to hire someone to help you out? Are you going to use index funds? Are you going to use active funds? How are you going to find those funds? That's the execution side. We'll spend more time on that. So we've been talking asset classes. What are the four major asset classes? Cash, bonds, fixed income, stocks, alternatives. All right. Do y'all remember the two risks to separate cash from fixed income? They're both bonds, right? You're loaning someone money. So how do you distinguish them? Reinvestment risk, price risk, and reinvestment risk and price risk. Price risk is also known as interest rate risk. But reinvestment risk, which has a lot of reinvestment risk, cash or fixed income? Cash, yeah, because you're constantly at the mercy of where interest rates are. You're constantly repricing. All right, fixed income has what? This is a tough one. You don't say it has high price risk and low reinvestment risk. You said it, you remember the words I use? Varying degrees. Short-term bonds have high reinvestment risk but low price risk. Long-term bonds have low reinvestment risk and high price risk. All right. So if we look at these major asset classes, bonds, cash, fixed income, I'll show you a couple of books here. The most famous one is Fabozzi, Frank Fabozzi. I think he's still living. He wrote this book, The Handbook of Fixed Income. It is a long, long book, almost 2,000 pages long. So this is not a book you would read. This is a book you have in your library as a reference. All right. They actually take chapters in this book and publish them as separate books. The guy who wrote Brangoni wrote the tips chapter. We'll talk about tips. He actually called us at USAA once. It was an interesting call, but we were talking to him. I go, hey, you wrote the tips chapter. He's like, yeah. And so he mailed us his chapter as a book with his signature in it. So I think they call him Brinjo, but he wrote that chapter. I don't know what Frank Fabozzi actually wrote, because this book, it says edited by, but this book was written by a bunch of different people, bunch of different chapters. I don't know how you, where's the look inside? Is it here? I always miss. If y'all see it, let me know. Read more bonds. I wish I could show you the inside of this book, but they used to do that. You could see the index. But it has chapters on what we're covering in this class, but it has chapters on stuff that is so incredibly specific and detailed. Now you can take John Toohey's class on fixed income. I highly recommend that if you have any interest in fixed income. It gets pretty complex, but it will cover DC cut size. So that is in there. About half of the book is the S of DC cut size, which is the structured debt. Half of this book is structured debt. We'll talk about mortgage-backed securities, which is a big part of this book. But I mean, you got collateralized loan obligations. This list doesn't even cover most of it. You got some structured, but it doesn't have mortgage-backed, asset-backed, those kind of things in it. Boy, I wish I could show you the index. So very good book. Did it actually show it? All right, that's good. And in this book, you can read this Tuckman book, Bruce Tuckman. It's a much shorter book. It's like 400 pages or so, or 600 pages. It is readable. It doesn't go nearly in detail as Fabozzi on some of these really specialized asset classes, but he does a really good job on strategy. I like the way he sets up strategy. He talks about barbell and bullet and laddering really, really well. Very good book, very well written. Probably cheaper as well, but a good read. If you wanted to get a book in your library, that would not be a bad one to read through. So fixed income gets incredibly quantitative, extremely difficult stuff, which means you could make your whole career on just one chapter in this book. It really is. That's the way fixed income is. Most finance majors forget bonds exist. They all want to be stock analysts or real estate analysts, but there's more bonds in the world than there are stocks, and they're a large dollar amount. And you can do a lot with bonds that you can't do with stocks because bonds are much more quantitative. So if you like math, you like doing formulas, fixed income lends itself more to doing the quantitative side. And then stocks, second. Stocks is ownership in the company. You're actually own part of the company. We're going to talk BUCS, bucks. So we'll get into this later. And then alternatives is everything else. Your exam question, the key with alternatives is really two things. It's diversification. And for real assets, it's some protection from inflation. We like commodities, real estate, timber, because they tend to keep up with inflation better than other assets. What belongs in alternatives just depends on the firm. Every firm has their own, what they consider separate. So like I said at USA, real estate was a separate class. So we had 5 classes. So let's start with cash. So cash, there's no subcategories in cash. Cash is cash. Pretty straightforward. For a lot of people, cash is not an asset class. It's just a place they park money until they find something to invest. Cash is loans, the governments, the banks. When you see treasuries, there's treasury bills, treasury notes, and treasury bonds. Treasury bills are the short-term ones. They're the ones that are considered to be cash. These are discount notes. A discount note doesn't pay interest. You buy it for 99 and it matures at 100. So there's no interest payment. It's just you buy it at a discount and matures at a higher amount. The government borrows short term. These used to be considered the most liquid asset on the planet. At least I used to think so until 2008 hit. It was a strange day. So we were doing derivatives on my stock portfolio. So we're buying protection on my stock portfolio, which means our options are maturing in 340 million bucks. It's a lot of money coming in. So I say no big deals. So I go to Donna. I just saw Donna this last week on Friday. Donna ran our bond portfolio at USA. I ran the stock portfolio. So I go to Donna and say, hey, Donna, just letting you know, tomorrow, like $340 million is coming in on some of my options. I'll just be sending over. And she goes, well, what do you want me to do with that? I said, well, just invest it. She says, where? I said, well, just buy T-bills. And she says, there aren't any. And I really thought, because she had a really good sense of humor and going, yeah, funny. She said, no, there are no T-bills. I was like, you're joking. There have to be T-bills. And 2008 was such a horrible year that anybody with a T-bill was clinging on to it for dear life. They were not going to sell that bond. So I go, well, it's your problem, not mine. You get 340 million bucks tomorrow. Good luck with finding a place to invest it. That was so bizarre. But that's how bad 2008 was. People were not selling their T-bills for any price. They were going to hang on to it because if they sold it, they'd now have cash. And what were they going to do with it? They didn't have a place to put it either. So I don't know what Donna eventually did, but there was just no place. But generally, T-bills are just incredibly liquid. They're easy to buy. I have several charities I'm working with where I buy ladder T-bills for them. Ladder means I just have them maturing on a pretty regular basis. I buy them through Schwab, which is really, really simple to do. And the yields, you see the yields. I've been shifting a little bit more to CDs just because the rates have come up a little more, but treasury bills have been a pretty decent place to be. Agencies are just other parts of the US government. They typically have a slightly higher return, but not dramatically so. They tend to be pretty liquid and tend to have pretty good. Corporations do borrow short term. It's called commercial paper. When I was at USAA, they had like a $3 billion commercial paper program. Usually it's very high quality entities. So they can borrow at really, really low rates for short term. So those are the typical short-term securities. You can combine these all together in a portfolio. It is called money market account that banks or mutual fund companies sell, and you can buy those. And you're not, back in 2020, you got almost nothing for those. They're paying essentially zero, but now you can get 4% kind of returns. It's kind of nice. You can go to banks, get certificates of deposits. So these funds, they buy the same thing mutual funds are buying or that you would buy. Now, when I was at USA, and it's probably worse in 2020, if you got a municipal bond, or not a municipal, a money market account, and you're charging 0.2%, 0.4%, and interest rates are 0.1%. We had this trouble, I think it was during 2008, where what they were paying was less than what you were charging in fees. Mutual fund companies didn't know what to do. How do you pay someone 0.1%, but you take 0.4% in fees? So a lot of firms just had to get rid of their fees for a few months while they're waiting for interest rates to come back up. What's the characteristics of these? They tend to be very low expected return. And even on long term, they tend to underperform inflation. So you're tending to just, after inflation, just barely break even at all. But their risk is very, very low, especially their price risk. We said they do have very, very high reinvestment risk, but their price risk is very, very low. So you don't have to worry about losing money. We'll talk about duration. Duration is essentially zero, which what that means is they're not sensitive to interest rates. Their price, when interest rates rise, their price doesn't fall. Their price just stays the same. Credit risk is usually very, very, very low. However, in 2008, the money market accounts that owned AIG and Lehman Brothers, there were some that had some losses. The oldest money market account in existence actually had a negative return, actually saw its price fall in 2008 because of credit risk, not because of interest rate risk. And people panicked. The federal government actually stepped in and guaranteed these funds. But you think about it, people were panicking and that fund was down like 1.3%. Stock market's down 40-something%, and people are panicking because money market's down 1%. That's how safe they're supposed to be, a 1% loss in one of these accounts, and people are just freaking out. Their correlation changes over time, but they tend to be a good place to be in a crisis. Most people would have been pretty happy holding cash in 2008 when the market blew up and they were just making, small returns, but at least it was positive. For most people, cash is just liquidity. It's a holding place until they're ready to invest. Most people don't view cash as a legitimate investment. It's a parking place. In your 401k plan, you're probably not going to have a cash option, but you might have a fixed option, not a bond option, but a fixed option. Those are interesting. I won't get into those, but those can be interesting. You can actually arbitrage against those and take advantage of them if you know what's going on. Some firms kind of limit it. It's kind of like buying a CD. You're guaranteed that the price won't fall. It's an interesting investment. That's kind of a cash option, but your 401k probably will not have a cash option. It might have a fixed fund kind of option, which is just an unusual investment. So Yeah, if you have a 401k plan, this cash will probably not be in there. You're ready for bonds? So hopefully you have your answer written for exam 1 through the major asset classes. So now let's talk about bonds. I love bonds. It's a great, great, great topic. So when I was at USAA, we did not really have fixed income in undergraduate or in graduate school. Most of my bond learning I got from the CFA exam, which was really, really good, especially part 2 of the CFA exam is really heavy on bonds. My best education on bonds was the actuaries at USAA. I learned tremendously from them. I was constantly talking to them and learning. And that's how I came up with this list, the DC cuts I. The first 2 are related, so kind of good that we have a break there. DC, duration and convexity, those are related to each other. We'll talk about duration and convexity. Convexity is the hardest one of all. Do your best on convexity. I'm not supposed to cover convexity undergraduate, but I think you can handle it. It is a very, very important concept. The next one, the C, is what most people talk about, which is credit. Probability that you're going to go on default, that they're not going to pay you back. The next 3 or next 4 are very specialized. U for US versus non-US bonds. Most people in the US don't buy non-US bonds. T for what? Anybody remember? Not Texas, but taxes. T for taxes. So we have municipal bonds. We had people here from Victory Capital on Friday. And the guy I was talking to was on the corporate side, so he does credit. But Nick Ramos, in fact, they have quite a few. They had 3 UTSA alums there on Friday. So Amara, she does corporates. Andrew does corporates, and then Nick was doing municipals and corporates. So municipal bonds have a special tax treatment, so they fall in that category. S is structure. We're probably going to talk more about structure when we talk about convexity, but when we talk about structure some, there's a lot under structure: commercial mortgage-backed securities, mortgage-backed bonds, asset-backed securities. There's a whole bunch. Structured debt. There's a lot under the S. This is where we're going to be the skimpiest. So probably about half of Fabosi's book is on the S, and that's where all the detail is. Anybody remember what I stands for? Inflation. So we now have inflation-linked bonds called TIPS. How did they do in 2022 when inflation was so high? They lost money. How can you lose money when you have an inflation bond? So we'll talk about those. How could they possibly? They didn't do horribly. You would have done better than you've done with other bonds, but they did have a negative return. So DC cuts I cannot think of anything else to add to that list. So I think it's a pretty good list. So let's start with duration. You probably know the term maturity. If you have a 20-year bond, it's going to mature in 20 years. But duration is a better measure of interest rate risk, and that's the key. So before we get into this, let's talk about what we're going to do this part of the paper exam. So for DC cuts I and bucks, DC cuts I is for fixed income. Bucks is for stocks. For each one of these, what you want to do is define it. What is duration? What is it talking about? You want the subcategories. And then you want the strategy. Now, on some of these, it won't be that much. For duration, there's 3 subcategories. For convexity, there's only 2 categories. For credit, there's several categories. And then the others, there's not as many categories. But define, what do we mean by duration? And there's several pieces of this. You can say it's a measure of price or interest rate risk. So it is a measure of risk. The technical term is the weighted average time to maturity using discounted cash flows as the weights. I'll show you that calculation later when you price bonds. You can see it's actually a really, really easy calculation. It's expressed in the formula expected percentage change in a bond price equals minus duration times the change in yield. Why minus duration? Well, because interest rates rise, bond prices fall. There's an inverse relationship. When interest rates fall, bond prices rise. All right, those are the kind of things you want to talk about and define on duration. Some measure our price risk. The higher the duration, the more price risk you have, the more sensitive the bond's going to be to interest rates. How does it differ from maturity? Well, maturity only looks at the very, very last cash flow, whereas duration looks at all the cash flows, including coupons. And it's the weighted average time maturity using all those cash flows. And this is how we express it. We'll give some practice here. I say the expected because duration won't give you a precise answer. And that's where convexity comes in. We'll talk about convexity. There's really two things that express how bond price will move: duration and convexity. That's to define. What are the subcategories? Well, my understanding of the history is Vanguard, the second largest investment firm out there, came up with these categories, and they came up with short term, intermediate term, and long term. Those are their categories. You can actually see it in their website. So here's their mutual funds, and we'll talk about ETFs, but here's their mutual funds. Nothing happens. Oh, there it was. Here's the mutual funds. And we're going to do asset class. That's what we're talking about, right? Stocks, bonds, cash. That sounds like ours. What are they missing? Alternatives. But they have sector and specialty where they have some alternatives in there. So let's just do fixed income. They have 89 fixed income accounts. What category does this fit in? California intermediate term. So that falls under duration. Tax exempt fund, where else does it fall? It's got the D of DC cuts I. What else do you have? Taxes, you got those in there. California long-term tax exempt. Emerging market bond fund, what is that? It's under DC cuts I, where is that? Under the U for non-US bonds. Ginnie Mae fund investor shares. What is Ginnie Mae? That's a structured product, and convexity is king there. High yield, we'll talk about that under credit, right? These are low quality, risky bonds. Inflation protected, where does that fall in your DC cuts I? That one's kind of straightforward, isn't it? Inflation. Intermediate term bond index fund. So intermediate term, there's a duration. They don't tell you what kind of bond it is, but if you click on it, asset class, intermediate term bonds, you can get, here's the fees. somewhere up here, they should show you. They show yield and maturity. Do they show duration? There it is right there. There's the duration. Yield and maturity is what you're expected to return. Here's the maturity. You'll notice that maturity is longer than duration. Almost always maturity is longer. Why? Because maturity only looks at the very, very last cash flow. Duration looks at all the cash flows. There's 2,500 bonds in this, or 2,300 bonds in this mutual fund. Pretty amazing. They have government bonds in there. They have single A bonds. They have triple B bonds. We'll talk about this on the credit, right? That's your credit. 56% is government bonds. What if you don't want 56% in government bonds? Then you'd have to buy a corporate bond fund, not this type of bond fund. Why does it have 56%? Because its benchmark has 56% treasuries, right? So the DC cut side dominates what you're going to see here on all of these asset classes. All right, short-term, intermediate. Which one has the shortest duration of these three? Pretty obvious, right? Short-term. What is short-term? Usually has a duration, say, to 2 to 3 years. Intermediate, 3 to 6 maybe. And long-term, 6+, but it can change over time. Because when interest rates are low, durations go further out. When interest rates are high, duration shortens, so it can change over time. Right? We're going to see all this again in the notes, but I'm just giving you one example. Strategy. For duration, your strategy is where do you think interest rates are going to go? So it's really important if you expect rates to rise. We're talking about interest rates. You want to shorten duration. If you expect interest rates to fall, you want to lengthen duration. That's your strategy. Really, really important term here. Some students really miss this on the exam. Some students say if interest rates rise, shorten duration. It's too late. It's already happened. You want a shorten duration before interest rates rise. If they've already risen, what might you do? You might actually lengthen duration then because you expect them to fall back down. So that expectation is important. So in the interview, don't say, wow, interest rates are really risen. I think I'll shorten duration. It's like, well, it's too late. You should have shortened duration before they rose. Right. So this is what you think rates are going to do. If you expect interest rates to rise, you want to shorten duration today. If you expect interest rates to fall, you want to lengthen duration today. All right, so that's just one example. So you define what we're talking about. You look at the subcategories, and in giving those subcategories, what do you do? All right, that's going to be really key for that second question on the exam, where I actually give you a scenario. You have to look and see, are we expecting rates to rise or fall? Oh, we expect them to rise. Well, I recommend we shorten duration. All right. So we go back to the class notes. So we got short-term, intermediate, and long-term. Duration is the weighted average time maturity. Duration is a measure of price risk, also known as interest rate risk. And what we mean is how sensitive is the bond price to changes in interest rates. The longer the duration, the more sensitive it is. The shorter duration, the less sensitive it is. Here's this formula, minus duration times the change in yield. I'll show you later how you actually calculate the duration number. Well, once you have the duration number, you can plug it into this formula and you have a pretty good estimate of how the bond price is going to move. Interest rates rise, bond prices fall. How much depends on the duration. The longer the duration, the more the price is going to fall when interest rates rise. All right. This is one of the most famous formulas in all of finance, but I bet you 90% undergraduate students don't know it in finance. So it's not taught all that much, but it's one of those things. There are places where when you interview, they think you know this stuff because they talk about it every single day. And then the majority of students don't know it. And so the interviewers are shocked. How can you not know this formula? We use it all the time, and yet it's just not talked much in class. But this is a very famous formula. I had a boss that used this like every week. He was always showing off. So percentage change in price equals about, this term about is really, really important. We'll see when we get to convexity. If interest rates don't change much, this formula does a really good job. If interest rates change a bunch, this formula can be way off, and that's because of convexity. So if you have a bond with a duration of 5 years and you expect rates to rise 100 basis points, remember divide by 10,000. 100 divided by 10,000 is 0.01. So you think rates are going to go from 4% to 5%. So you take minus duration, duration's 5 years, minus 5 times interest rates rise 100 basis points. You'd expect that bond price to fall 5%. That doesn't necessarily mean you'll lose 5% because the coupon might be 4%. So you'll make 4% in income, but you'll lose 5% in price. So you lose 1%. But the price, this is telling you what the price is going to do. So on bonds, you get income, it pays interest, but then the price changes. So if interest rates rise 100 basis points, you'll get your income, maybe that's 4%, but the price falls 5%. You lose 1%. You buy a long-term bond mutual fund with a duration of 8 years and rates rise 200 basis points, then minus 8 times 0.02, that bond would fall 16%. So can treasury bond prices fall 15, 20, 30%? Absolutely. Treasuries were down over 20% in 2022 because interest rates rose, especially long-term treasuries. Long-term treasuries can lose a fortune. But on the flip side, they can make you a fortune. So in 2008, long-term treasuries were out like 30, 40% as interest rates fell. So long-term treasuries are very sensitive to interest rates. That's going to kill you in a year like 2022 when interest rates rise. It's going to save you in a year like 2008 when interest rates fall. So you have to just be really, really careful. If rates fall 150 basis points, you have minus duration, minus 8 times minus 0.015. In that case, the bond price should go up 12%. In that case, the bond price goes up 12%, plus you make the income, which might be 4%. In that case, you'll make 16% on that bond. All right, so we're only talking about the price here. Questions on this? We'll use it when we price bonds. I'm going to use this to somewhat test our understanding of duration and also give you a good way to estimate the answer on the exam, because you can use this formula as a good estimation. That brings up the yield curve itself. I think we looked at the yield curve earlier. Not this page, though. Let me find a better one. We got a pretty wicked looking yield curve right now. The 10-year is higher than the 2 years. And how much? Just remember that the 10-year normally is 70 basis points higher than the 2-year. Remember that 70 basis points. Right now, we've got 4.54 versus 4.26. It's only 28 different. So it's normally 70 different. Now it's only 28. So it's actually a fairly flat yield curve right now. It's not particularly steep. It looks steep, but that's because the axis is really narrow. All right. So let's see if I remember what I just said. The 10 versus the 2 is normally what? 70. Today it's 28. So it's pretty flat. If you go back, (2023), what does that look like? What do we call that? Inverted. Does it look like the 10-year is 70 basis points higher than the 2-year? 353 versus 430. No, it's like 80 basis points lower. So that's an inverted. What's that yield curve telling us? recession. How good of a job did it do predict a recession? It failed. We didn't have a recession in 2024, but that's what it was expecting. Recession in 2024. Let's see, I'm trying to think of a year where it was really, really steep, maybe 2019. Here, the 10-year was 2.7. That's not very steep. I can't think of a steep year. Here, the 10-year interest rates are essentially zero, 168. Yeah, that's a steep curve there right there. 168 versus 47, that's like 120 difference. That's a lot bigger yield curve. So, and you can get this, I think I showed y'all, you just do Fred, 10-year minus 2-year, and Fred will bring that up. So here's the actual 10-year minus 2-year. I think we saw this. I showed y'all this previous class, I think. Remember the economic indicators, some are leading, some are coincident, and some are lagging. The 10 minus 2 is which one? Leading, coincident, or lagging? Does the 10 minus the 2 predict the economy, or is it telling you where you are or telling you where you've been? It's a leading. So what do you notice? Negative recession, negative recession, negative recession, negative recession, negative, no recession. So this last time it failed. Or the recession is still coming, it just hasn't gotten there yet. But you can see where we are today. In previous times, I mean, it can, I mean, it's possible. That's a pretty long period of time here. It's possible we still have a recession coming, but it does a pretty good job. We've never had a recession without a negatively sloped yield curve, but we have had negative sloped yield curves without a recession. So here it was negative 106. That's a very, very negative. The normal is 70. So you can see we've had some really negative. And then in 1980, yeah, we had 2 recessions right in a row. Was it actually showing that? Yeah. Okay. This screen's going to drive me crazy. So in your economics class, hopefully you did all the theories on the yield curve. Y'all remember those? Expectation theory, the demand, the risk premium, all those theories are good to know. So let's get into the strategy then. Now I'm giving you the jargon of our field. And I don't know who came up with this jargon, but you're somewhat stuck with it. So we don't say reduce duration, we say shorten duration. So if you want to sound like you know what you're talking about in an interview, you talk about shortening duration. Don't say I want to reduce, bring down duration. You say you shorten duration. And on the other side, we use the word lengthen. We don't say increase duration, we say lengthen. I don't know why, who came up with those terms. Those are the terms we use. So your boss believes interest rates are going to rise. So it's a future projection. You recommend the firm shorten the duration of its bond portfolio. Your boss believes interest rates will fall over the next 12 months. You want to lengthen duration, right? It kind of makes sense, right? You think interest rates are going to fall, buy longer term bonds and lock in today's rates. So when they fall, you got those higher rates locked in. Are you expecting interest rates going to rise? Well, sell your longer term bonds, buy shorter term bonds. Then when rates rise, you can reinvest in those much higher rates. So it makes intuitive sense. All right, questions on duration? What are the 3 things you're going to talk about on the exam? First thing you do with duration is you define it. So weighted average time maturity using discounted cash flows are your ways. Second thing you want to do, what are your subcategories? Short term, immediate, long term, and then what's your strategy? Be real precise. I start with if you expect what? Interest rates to rise, short duration. All right, just be really precise on the exam and your answer. Okay. So now we get into a really cool topic. I don't know if John Tuohy talks convexity much. So convexity, so duration is the first order magnitude of bond prices and interest rates. It's like the first derivative. Convexity is the second derivative. The full formula, remember this formula, minus duration times the change in yields? That's the formula everybody knows. But you can add convexity times the change in yield squared divided by 2. When you take the change in yield and you square it, you get a really small number. You square 0.01, you get a really, really small number. And then we divide that by 2. What that means is convexity doesn't have much impact unless interest rates move a bunch. When interest rates don't move much, convexity has very small impact. Let's see if I can get into this page. All right. So one of my students built this for me, I think, in Python. Let's do a 30-year bond with no coupon, and the yield is 5%. So this is the output. So what this is showing you, you have this bond that you bought right here. As interest rates rise, as interest rates rise, the bond price falls. As rates fall, the bond price rises. This blue line is using this formula, minus duration times the change in yield. Got loaded again. Right? It's a straight line. And if you look at, if interest rates are moved between 200 basis points plus or minus, duration does a pretty good job at getting the price of that bond. The green line is what the bond price actually does. The blue line is what duration says. So if interest rates move 100 basis points, you can see the green and blue are right on top of each other. There's almost no difference. What happens when interest rates move a bunch? When interest rates fall, what happens to the actual bond price? It actually goes much, much higher. And what happens when interest rates rise? The bond doesn't fall as much, which is really good, isn't it? When does convexity hurt you? Nowhere. It always helps you. We love convexity. This is called positive convexity, and most bonds have positive convexity. That's a wonderful thing. We love convexity. The convexity on this bond, the duration of this bond is almost 30 years because it doesn't pay any interest. Its convexity is 900. Is that good? Well, let me show you a 5-year bond. Its convexity is only 28. Not much convexity. How good of a job does duration do on forecasting that bond's price? Does a pretty good job, doesn't it? Pretty good estimate. Not a lot of convexity. What about a 1-year bond? There's almost no convexity at all. So long-term bonds, boy, they move a lot when interest rates move, but they have a lot of positive convexity. And that can help you a lot. But always remember, convexity is important when interest rates move a bunch. That's going to be really key to our discussion in convexity. When does convexity matter? Convexity matters when interest rates are volatile. When interest rates are really volatile, convexity becomes extremely important. When interest rates are tame and not moving much, convexity is not that big of a deal. You can see it in this formula. You could put this formula on your exam answer. I always have to look it up. I can never remember the square, then the divide. But this formula everybody knows in finance. This one we often have to look up. The calculation, I'm going to show you how to calculate the D of this formula. The calculation for the C of this formula is really, really complex. It's really, really tough to do. But why does convexity do this? It's because when interest rates fall, duration goes longer. So duration is changing while interest rates are changing. That's why you need convexity. And when interest rates rise, duration shortens, and so convexity changes. And that's why it helps you, right? We say, hey, if interest rates are expected to rise, we want to lengthen duration. Well, when interest rates rise, let's say that backwards. When interest rates are expected to rise, you want to shorten duration. Well, as interest rates rise, duration shortens automatically without you doing anything. So it's like, it's helping you. Convexity is helping you when rates rise, and it's helping you with interest rates fall. So bond prices don't really move in a straight line like this formula suggests. It's convex. And if you want to use this website, it's a really cool site. I didn't pay anything to do this. He saw this class, and within a couple of days, he built the entire thing. I was like really impressed. Why is this important? So here we're going to get into a topic, and oh my word, 4:56, right? That clock's right, hopefully. So we need like 3 hours to talk about this, so we'll just get started today. It's a really, really cool topic. So for treasuries and corporates, it's not that big a deal. You'll get the picture just like I showed you. You have a straight line for duration and convex for the actual price. But there's some bonds that act really bizarrely. And they have something called embedded options. What is an embedded option? You're giving the borrower the right to do something. When you give someone the right to do something, will they do it when it's in their best interest, or will they do it when it's in your best interest? In their best interest. What option do you give these people? Well, let's talk about a mortgage. What option do we give mortgage borrowers? What do they get to do? Refinance. When are they going to refinance? If they borrow at 6% and rates shoot up to 9%, are they going to refinance? No. When are they going to refinance? They borrow at 8% and rates fall to 4%. Wouldn't you love it if you loaned them money at 6% and rates shoot up to 9% and they refinance? You'd be really happy, wouldn't you? Like, well, it'd be great. Yeah, you want to pay me that? They're not going to do that. They're going to execute that option when it's at your disadvantage, which is bad news for you and great news for them. So some bonds provide the option for the borrower to pay off the loan early. And that is an option, just like we're going to talk about options later in the class, stock options. It's an option. It's priced just like any other option. And these are called mortgage-backed securities. We'll have to talk about mortgage-backed securities here. So when you buy a mortgage-backed security, when you buy a mortgage-backed security, it's a collection of mortgages. You're actually buying one thing and selling something else. You're buying a bond. We just call it a straight regular bond. And you're selling a call option on interest rates, which makes it a really complicated transaction. These are really, really complex securities. So you're buying a bond and you're selling an option. We're going to talk later about options. When you buy an option and volatility rises, your option price goes up. So if you buy an option on Apple stock and suddenly the stock price gets really volatile, that option is being worth more money to you. So when you're buying an option, we like volatility because it makes better chance you're going to make money on it. But we're not buying an option, are we? What are we doing with a mortgage-backed security? We're selling an option. Guess what? We hate volatility. We like nice, smooth markets, but we hate volatility. Why? Because if interest rates get really, really volatile, what's that mortgage person likely to do? They're much more likely to refinance. Right? If they borrow at 6% and interest rates stay at 6% for the next 30 years, are they going to refinance? No, they're not going to pay all those fees to refinance. But what if interest rates get really volatile? They shoot up, they fall. What are they going to do? When they fall, they're going to refinance. When they shoot up, they won't. So that volatility is terrible. So you're actually buying a bond, selling an option, and selling an option is terrible if interest rates suddenly become really, really volatile. All right. Selling interest rate options is bad when interest rates become volatile. What kind of bonds have embedded options? You have convertible bonds. We're going to ignore those. Those you can convert into stocks later. We're going to completely ignore those. That's the entire world. There's even a hedge fund strategy, convertible ARB, which does convertible bonds. We're going to ignore those. I don't really like convertible bonds because I can never remember the formulas because I don't deal with them. But callable bonds, when you loan money to corporations, you do give them the option to pay off the debt early. Usually there's a lockout period and they have to pay a premium to do it. So they may have to pay an extra 1% or 2% to do that. But are they going to do that in their best interest? Absolutely. Now, how could you study this more? Let me just show you how cool this is. Y'all have heard of yield to maturity, right? What is yield to maturity? That's your return on the bond if you hold it to maturity, as long as they don't default. But what's wrong with the mortgage-backed security? You may not get the hold at maturity, right? Or a callable bond, because what might happen before maturity? They might pay off early. So anybody know the term for callable bonds that's not yield to maturity? It's YTW, if that helps you. What is YTW? W. Yield to. So the borrower is going to do what's in his best interest, which is going to be to you what? Your worst. Yield to worst. What is yield to worst? So for callable bonds, what they do is they look at every conceivable yield, yield to maturity, yield to the first call date, yield to the second call date, given where interest rates are today, and they figure out the yield that's the worst yield based on where rates are today, because that's what you're most likely to get. So if you loan money to IBM and they can pay it off after 2 years at a 1% penalty and after 3 years with no penalty, they're going to use the yield to worst and they're going to calculate the return on all those different periods. And yield to worst is that worst possible yield you can get. The lowest possible yield that an issuer can pay on a bond without defaulting. So given where interest rates are today, I don't like Investopedia, but given where yields are today, that's what they're telling you. That is your most likely return today. The yield to maturity might be 6%. The yield worst might be 5.2%. You're more likely to make 5.2 than you are to make 6% because they're likely to pay off that debt early. So callable bonds, they have a lock-in period, so they can't prepay, and then at some point they can, usually for some premium. We're not going to do much with callable bonds. They're not radically different than regular bonds. There's a little bit of a difference there. I will say with callable bonds, because there is a risk that you're going to get a lower return than you expected, these bonds do pay higher interest. So a bond that's not callable might pay 6%. A callable bond might pay 6.2%. So you are paid, and that's where you're selling that option. We're going to get into this. It can get quite complicated. But let's look at the real action is, and that's mortgage-backed securities. Have y'all heard of mortgage-backed securities, MBS? So are y'all familiar with securitization? Y'all heard of that term? So what is securitization? It's when you take something that's not a security and you make it a security, right? Let's say your neighbor borrowed $500,000 to buy a house from Frost Bank. So you call it Frost Bank and says, hey, my neighbor just borrowed $500,000 from you. I want to buy his mortgage from you. And what's Frost likely to say? It's like, we're not going to do that. We don't have the infrastructure set up to do that. So what's Frost actually going to do? Frost is going to take your neighbor's debt with a bunch of other mortgages, put them together in a trust, and is going to go out there and put it on the market. So they're going to create a trust. It's not a subsidiary of Frost. It's a completely separate entity. They're going to put a bunch of mortgages in there. that entity is going to go out and borrow money equal to the market value of all those mortgages. And how are they going to pay that debt off? Anytime someone pays money on a mortgage, they're going to send that out to the whoever loaned them money. There's another term for this. It's called pass-through securities. So Frost doesn't want 30-year mortgages on their balance sheet. They're really short-term, very short-term bank. They don't want 30-year bonds, but they'll lend out 30 years. But then as soon as they finish lending out, they'll take all those bonds, put them in a trust. They'll get their cash today by borrowing money from the market. And then the market now has this big trust loaded with all these Frost bonds, mortgages. And as the people who borrow money from Frost pay off the debt, that money just gets sent to the lenders, to the trusts. Which means if you have a mortgage from Frost and you pay off the mortgage early, guess what the people lending to the trust get? They get your prepayment early. All right, so it's just a pure pass-through. Frost is still the bank of record. They're still servicing the debt. They get a service fee for doing it. As far as you know, Frost still has your debt, but they really don't. They've sold it off to the market because they want their cash. When I was at USAA, USAA was doing securitization $15, $20 billion a year. I mean, they're just every loan they get. What can you securitize? Mortgages, car loans, credit card loans. It's loans to corporations. There's all kinds of things you can do. That's called securitization. In 2008, we had this term probably not used anymore. They call it shadow banking. It looks like Frost and JP Morgan and Bank of America are making all these mortgage loans, but they're really not. They're making them, but then they're selling them off to the capital markets to get them off their books. So it's kind of shadow banking. They're not really the lenders. They're just kind of the setup people. They get the servicing fee. All right. So mortgage-backed security is an asset-backed security, ABS. So asset-backed securities are mortgages, auto loans, credit cards. And banks bundle up all their loans, put them into a trust. That trust then borrows money on the capital markets. And they pay back that loan by simply passing through whatever the retail borrower pays back. Which means asset-backed securities, when people prepay their debt, they get that cash early. Auto loans is not a big deal. Most people don't pay off their auto loans early because of interest rate risk. They may pay it off early because they just don't want the loan anymore, but you probably don't know too many people who say, hey, I'm refinancing my auto loan because interest rates are lower. That's pretty rare to do. But with mortgages, it happens all the time. Credit cards, you don't really do it. Most people pay off credit card loans just because they want to get their debt down. So mortgage backs are really the important ones here. They are a part of the asset-backed securities, and there's several of them. Mortgage-backed securities have negative convexity. And why is that? Oh, that's not it. I don't know if I can find, there it is. Why is that? Well, what happens when interest rates fall? At some point, what are they going to do? They're going to pay off that mortgage at par. The price can't go up anymore, right? If you loan them $500,000, and anytime they can pay off $500,000, once interest rates fall enough, they're just going to pay you $500,000. That mortgage can't go to $600,000. So you're going to get 500 back. So what happens? The green line doesn't keep going up. At some point, the green line goes over like this. It's actually below the blue line. Y'all know what we call that? If the green line is positive convexity, what would this be? Negative convexity. Your convexity can actually be a negative number, which is terrible. We don't like that. So we'll talk about why would you ever do a bond like this? Any guesses why you would ever do a bond like this? What do you think you have to do with the mortgage to get people to do this mortgage-backed security? So the answer is going to be, we'll get into this. If you want to really get in, look up OAS. But if banks offered mortgages and did not allow anyone to pay off early, if you did a 30-year mortgage, you have to keep paying for 30 years. they might charge 6%. But when they allow you to pay off early, now they're going to charge you 6.25%. They're actually going to charge you more to give you that right to pay off the debt early. That extra 0.25%, that's your call premium. That's that extra premium. We're going to talk about this. If you want to really get into it, there's something called option adjusted spread. We'll talk about that on Wednesday. It's really complex. Not only is it complex, but I think Investopedia has it wrong. Every time I read Investopedia, it's just not written correctly. And I'll tell you my view. I'm pretty sure I'm right because that's what was on the CFA exam, and I trust the CFA exam. But it's a complicated enough topic that I think Investopedia gets it wrong. So we'll get into this on Wednesday. So be ready for some brain. We're going to do a team question on Wednesday too, right? Closed book on the exam one answer. So, all right, I'll stop it there.
So you can start on paper one on Friday. I recommend you do start it on Friday because the articles will be there. You could do this whole paper sitting at a Bloomberg machine, which is probably the best thing to do. If you get a Bloomberg account, you just type ECO, which is economics, and all kinds of stuff will come up. You can get some really good charts. This is the website I gave you in the paper description. So we had a really strong December. We had 256,000 jobs added. The consensus range is pretty wide this time, but they're expecting 158,000. That's not a weak number. It's just this number was so strong. It was a pretty shocking number. Good chance that it will be, well, it will be revised. Good chance it could be revised down. So you will actually talk about the prior number being revised. The range is important because if it's outside of that range, that means it's really shocking. So if it comes in at like 250 again, stocks will probably sell off because that means the Fed's just not going to be cutting rates. Interest rates will definitely rise in that scenario. The unemployment rate is expected to stay the same. It did last month from 4.2 to 4.1. If it falls to 4, that would be somewhat surprising. But that's the expectation. The range is pretty tight on that one. The prior does not get a revised here, so you don't have to talk revised. You talk about the revised number on the payroll, but not on the rate. The rate doesn't get revised. You do talk about the private payrolls. It does get revised, and you look at that number. The difference is government jobs, and so sometimes the private can be surprising versus the government numbers. I wouldn't talk about manufacturing. If I were you, I would go to the Department of Labor sites where they give you a really good chart. A lot of students that discover it, where they go industry by industry and they show you how the jobs change. I don't know why manufacturing gets its own little line on this report. You will talk about the participation rate. Very, very important. That's one you might do some history on. It's pretty easy. Remember, if you want to do a chart, you just do Fred, participation rate, and the chart. You got a chart just like that. You can do the max. And you can see the participation rate is very, very, very low. It grew in the 70s. Did we talk about why did it grow in the 70s? Who joined the workforce in the 70s? Women joined the workforce. So we went from the upper 50s, low 60s, up into the upper 60s. Since then, it's been trailing down. There's been a lot of discussion about where are these people going? What are they doing? Some people think it was the 2008 crisis that a lot of people went back to college because they couldn't find a job. So they say, well, if I can't find a job, at least get education. But then that should have popped back up later. It's just really, really come down. Some people say the baby boomers. I don't think the baby boomers really have retired that significantly yet to make those numbers. There's a lot of questions about why that number is so low. COVID destroyed it. But you can in your paper say, you know, the participation rate has been pretty flat last few months, still below pre-COVID levels. That's a serious issue. Where are all these people? What are they doing? We have had a high incidence of disability, so there's a lot of people on Social Security disability. A lot of them left the workforce. They're getting paid off of Social Security and they're disabled. Why was that jump there? It's really hard to explain why that number is stayed so low. It was really consistent for about 5 years. I mean, COVID obviously blew it up, but it hasn't gotten back to pre-COVID levels. So we're back to where we were in the mid 70s after all of that. So that's an important number. These tend not to get much focus. We know inflation's pretty important, so it's possible if there's a surprise there on the inflationary side, that could be important. And the work week generally doesn't get a lot of attention, but most students do talk about it. So tomorrow, sometime tomorrow, this report, I'll make a picture of it. So I'll make sure if you didn't get it. The problem with this website is once time passes, it's hard to go back and look at it without having a subscription with them. So you want to look at it on the day of and then read articles. You will always see articles on this report. It's probably the single most important economic release of every month. So you always want to look at that and see what's going on. They'll also show you the ISM. So if you're going to look at the ISM, it came out really, really strong. They do give some graphs sometimes that are kind of interesting. And the ISM and PMI used to be the same, and then they split them off, so it gets confusing. But ISM is the one you really want to talk about. There's more detail in ISM than what they're showing. And probably the most important number is the new orders. They don't show it here, but if you go to Bloomberg, they show all of that. You can see how strong new orders were, because that ISM is future looking. One thing to really remember on this paper is the paper is about the jobs report. And we'll talk about this on Monday. That's all your boss asked you to write about was the jobs report. He didn't ask you, hey, what about ISM? So why would you put ISM in there? And this is where students lose a lot of points on clarity. I've seen papers, just to give you some examples. And I can tell some students are writing their paper by just looking at the student example and doing exactly that. You got to get out of that habit. You got to write your own stuff. But you got the jobs, you got the rate, or the market reaction. That's the baseline. That's like 70% of the paper. The rate also has the participation. So participation goes with the rate. The sectors go with the jobs. We don't have unemployment rate for healthcare, for government, it's the number of jobs. Private payroll goes here. But where should the ISM go in? Well, a lot of students put the ISM here. That doesn't make any sense. Why would it go there? Why do students do that? Because one of the student examples I gave, that's what the guy did. And so every student copied that afterward. Where would ISM go in? Well, if I were you, I'd put it here and I would do an intro. Something along the line. So your boss didn't ask for ISM. So you got to explain why it's there. You can't just throw ISM in if your boss didn't ask for it. So to give greater context to the jobs report, I want to also discuss the ISM in Monday. Something like that, not exactly those words, these are words. So then your boss says, oh, now I see why you're talking about ISM. That could be other things as well. If you want to do the JOLTS report, under employment, there's other reports you could do. Some people want to do jobless claims. I don't know if that don't randomly put it in there. Look and see if they're interesting. Jobless claims, I think, comes out on Wednesday. I don't see it. There, it came out on Thursday. Oh, that's tomorrow. So we don't have them yet. So probably jobless claims doesn't normally move markets, but if it shocks, so again, you just have to look and see if there's something there. Don't add it just to add something. So is it meaningful? I think ISM could be good this time because it jumped above 50 for the first time in 27 months. The ISM has been below 50 for a very long time. That to me is kind of somewhat of an interesting piece of information. There's other things, durable goods, industrial production. There's other things that have come out. This is a pretty heavy week for data. There's a services index. We almost never talk about that, and it's been so strong for so long. We're not really sure it really tells us anything. There's the JOLTS. If you want to look at an interesting one that, you know, some people do get some stuff out of job openings. There's other things that can be interesting. So that's why I gave you this calendar. You might look and see. You don't want to talk about everything. You're looking for something that is interesting, eye-opening. Articles may give you some insights too on what to think about, what to talk about. Yahoo Finance does a pretty good job on the jobs day, giving you some good insights and some good charts. The Economist as well. You just go into the news function on the Economist and you'll see some really good stuff. So what you want to do is figure out your sources, what you're going to look at. And even after this paper is due, you still do that because there's factory orders right there. Another weak number, still negative. Factory orders is weak. So I don't see any other major ones. So you're going to be looking at this one, very, very important one. There's a job cuts report. See how many people are doing large. Productivity and cost can be important. Okay, so I'm going to continue. So, do y'all know the definition of productivity? You probably had that in your eco class. Anybody know? Remember? Let's say you talk about productivity. What productivity is. Well, first let's look at it because it's been so horrible for so long, but I think we've actually had a decent comeback on it here recently. A little bit of comeback here recently, but that's productivity. On a chart like this, what I like to do is actually put it into Excel and create my own chart because it's just too noisy to do it this way. This is quarterly data. So what I like to do is quarterly data. So let's do 5 years. So that's 20 quarters. I just like to look at a rolling 5-year average. You can see how much productivity came down, and we have had this little bit of a recovery. But all productivity is, it's a really important number because your future wealth is entirely dependent on productivity. The wealth of every nation is productivity. So you have real GDP, which is the growth in the economy, less inflation. You have growth in hours worked. Any guesses what productivity will be? Using these two numbers, any guesses? All right, so it's real GDP minus change hours worked. That's what productivity is. If you can produce more and people don't work more, you're wealthier. The GDP is 3.2%, and hours worked is 1.2%. What is productivity? It'd be 2%. Historically in the US, productivity has averaged 2.2%. Since COVID, we've averaged 1.9%. If you take that one ridiculous quarter out, we've averaged 1%. So historically, it's been 2.2%. Since COVID, we've been half of that, 1%. That means we're getting poorer. We're not as rich as we used to be. China got a lot richer because their productivity is like 7%. You give a farmer in China a Deere tractor and they've never had one before, how much does their productivity go up? It's not 4%, is it? It's like 40 million%. It's pretty massive. I was listening, I highly recommend Business Breakdowns. If you are not listening to that, that is the best podcast. Today I listened to one on SpaceX. It's pretty amazing what SpaceX is doing. You know, they're getting to the point where the cost to deliver something to space is now cheaper than what it costs the post office to mail something through the post office on a per pound basis. Do you know that SpaceX can deliver people and equipment anywhere in the world in like 40 minutes? How long did it take you to fly to New York City? Would you like to make it in 40 minutes? Kind of nice, wouldn't it? So the things they're talking about, it's pretty incredible. Will they get there next 5-10 years? I don't know. Elon Musk is pretty pushing the envelope and that kind of thing. That's huge productivity. So they're talking about the cost used to be $10 million per kilowatt hour. Now it's $10. That's productivity. That's just amazing. We're much, much, much wealthier. I just did this chart. When I was in college in 1980, how long would it take me to do this chart? Several months. What have I done? Drawn it by hand on a piece of graph paper? And I just did it in a few seconds. That's productivity. That's the wealth of nations. You need productivity. So we'll talk about that a lot, especially on paper 3. Pretty critical. But you see, productivity used to be much higher, like in the 2.5% range. And then it just really dropped. So that might be something. Productivity comes out this week. Productivity, I think, is a really important number. Extremely important number for companies to do more with less. Extremely important number for nations. One of my favorite writers, Robert Arnott, he has an entire paper. You want to invest around the world where productivity is the strongest. And so where the change in productivity is the strongest. So who's more productive, a 40-year-old worker with 20 years experience or a 20-year-old college student? Who's more productive? The 40-year-old. Whose change in productivity is higher? The college student. So he says you want to be in countries with young populations with high productivity. The change in productivity is the key to where you want to be as a stock investor. It's the key to change in wealth. So it's an extremely important number. Do you want to talk about it this week? I don't know. It might be an interesting one to talk about. You see, recently, it's the last 2 quarters, it's been pretty decent. This last year, it's been pretty decent. We've averaged 2.6%. But then we had some really weak, all that inflation. And well, 2021, 22, that's when we had the supply chain disruption and those kind of things messed things up. We've come out of that really strong. So we've actually had really strong productivity. I know you can't tell with the election, it's either the world's perfect or it's all coming to an end. Everything's so exaggerated, but we've had some really decent numbers this last couple of years on productivity. The average has been the last 5 years, 2%, which is a pretty decent number for us. But then a decade, I remember President Obama, he wrote an article in The Economist right at the end of his second term. And they asked, or he decided to talk about what was his biggest regrets, and productivity was his biggest regret. During his presidency, productivity was just not just him, but a lot of places around the world, productivity was just really weak. He averaged, during his reign, it was less than 2%, 1.6%. And so, yeah, how can we fix productivity? Talk about education and training, those kind of things. But So that's just one example. You've got to pick what you want to talk about. But if you're going to talk about any of these things, make sure you set them up. Why are you talking about them? Why are you putting them on paper about jobs reports? Then you start to talk about the market. And you have to talk about the S&P 500 and the 10-year Treasury. Then you're going to talk about others. And you got to pick the others. We'll see on Friday which ones react. We're talking about markets on Friday, not for the year, not for the last 5 years. How did the market react on Friday? So hopefully you have a big report and it's shocking, and we'll see what the reaction is. All right, so let's do our team question. The team question is, someone comes to you and has 500,000. How do you help them? High level. So we're talking define what you're going to do for them, portfolio question, and then what 3 questions you ask them. All right, with no notes. You can't be looking on the computer. You can't be looking at your notes. This is how much your team knows. I only need one answer from a team. So you're not doing it. You can split it up. You want one team member to do one question, one to do another. You can't split it up. So I'll give you about 5 minutes. So move fast. So just to clarify, so the exam 1 has 2 questions. One is essentially you're summarizing pages 3 through 18 of the class notes in your own words. That you're going to submit on Canvas as a Word document. It'll be due 4 o'clock on the day of the exam. And then the second question we'll do in class. Don't worry about the second question because we're gonna do a lot of examples in class, but it's applying what you did on question 1 to a real life situation. We talked about with duration, you expect rates to rise, you want to shorten duration, those kind of things. So you'll see that as we get into it. Okay. So last class we were talking about convexities. So I don't know if any of y'all looked up option adjusted spread. It's not a term many undergraduate students know, but it's a really important term. Let me show you the definition I was taught on the CFA exam, and then we can look at Investopedia, and I can show you why I think they're wrong. But let's say you have a mortgage-backed security, and its current yield is 4.5%. But that 4.5% is you giving the person the option to pay off the debt early, which is really, really bad. It gives us negative convexity. So you want a higher return. If you're going to give them that option, you want a higher return. If you didn't give them that option, if you told the person with the mortgage, you got to pay your mortgage exactly on schedule. You can't pay extra. You can't pay it off early. You can't refinance. Then you'd only charge them 4.25%. Okay. If the treasury yield is 4.1, you've got 2 spreads here. You got one spread over treasuries that is 15 basis points from 4.1 to 4.25. Then you got another 0.25% that's covering you for that option you provided them. So what is the option adjusted spread? The option adjusted spread is this 15. It's the difference between the 4.1 and what the yield would have been if you didn't provide them the option. This 25 basis points between 425 and 450, that's the actual option premium. That's how much you're getting paid for giving them the option. All right. I think Investopedia, well, look at it. They may have fixed it. I think Investopedia calls the 25 the OAS, but the OAS is not the 25 bips. It's the 15 bips. So let's look at Investopedia and just see what they say. And even Wikipedia, I think, gets it wrong. First of all, they give you a definition that means nothing. So just look at the definition. The option adjusted spread is the measurement of the spread of fixed income security and the risk-free rate, which is then adjusted to take into case embedded options. That doesn't tell you anything. It's really confusing the way it's written. This phrase, which is then adjusted to take into account. How? How is it taken into account? They don't tell you that. They just say, somehow we're going to take it into account. It's almost like they don't know what OAS is, but they know it has something to do with that. So this is kind of the answer you get from college students. We're talking about something, not sure what the answer is. You throw in a lot of fancy words and hope no one notices. The spread is added to the fixed income security, what spread? The OAS, to make the risk-free bond price the same as the bond. That tells you nothing. So I don't know who wrote this. OAS measures the difference in yield between a bond with embedded option with treasuries. That's not true. Here's the bond with the embedded option, 4.5. Here's the treasury. That makes it sound like the OAS is 0.4%. But what is the OAS? Anybody remember what we said here? The OAS is what? 15 basis points. The option premium is 25 basis points. All right, so what the OAS is trying to tell you is how much spread would this bond give you if you didn't have an option? Essentially, that's your credit spread. That's how much you're going to pay for credit risk. I can't control Investopedia, but embedded options are provisions included in something. We've already talked about that. OS considers how bonds embedded option can change in the future. It actually doesn't. The option premium considers that. So this 25 bips, it is going to rise when interest rates get volatile, and it's going to shrink when interest rates are nice and tame. Because that's what we talk about. Options are more expensive when things are volatile. They're less expensive when everything's tame. So I don't like Investopedia. I think that's a terrible definition. They say understanding, and I wish they'd start with themselves. Helps investors compare. That's fine. It's like they're avoiding just telling you what it is. It's really, really frustrating. How does Wikipedia do it? OAS is a yield spread which has to be added to a benchmark yield. That's the 10-year treasury to discount a securities payments to match the market price using a dynamic pricing model that accounts for it. There they go again. What's my question? How? How does it account for it? So it's like the people writing this are like, I'm not really sure what OAS is. OAS is model dependent. That's absolutely true. If you go on Bloomberg and you look at OASs on Bloomberg, you will get different OASs depending on which bank did the calculation. It is a theoretical number. This concept can be applied to mortgage-backed securities or other bonds with embedded options. That term is so important. Or any other interest rate derivative or option. More loosely, OAS of a security can be interpreted as an expected outperformance versus the benchmark if the cash flows and yield curve behave consistently with the valuation model. They still haven't told you the answer. Oh, here we go. Definition. Okay, great. OAS quantifies the yield premium using a probabilistic model that incorporates two types of volatility. They still haven't told you. So I'm giving you the definition I used in the CFA exam. I'm quite confident it's the right definition. So this 425, we know the 4.5 with no problem. We can look that up. We know the 410 with no problem. The 425 is the model part. What would this bond's yield be if we didn't give them the option? That's very theoretical. We have to just guess what that is. Or their model might calculate the 25 and they calculate the 25. So how much, given how volatile interest rates are, how much should that option premium be? And once we figure that out, then the rest goes here. But either way, the definitions out there are pretty, and there's not very enlightening. So that's OAS. Think of OAS as the credit spread, and then you have another spread to cover for the optionality. What's the OAS of a treasury? Well, it's zero because it's risk-free. What's the OAS of a non-callable corporate bond? Well, it's whatever the spread is. So if Walmart borrows money for 5 years and they borrow at 425, and the 5 year is 410, then the spread is 15 bips. There's no more spread because there's no optionality. All right, so all of the spread on a non-callable bond, all of the spread is option-adjusted spread because there's no option to adjust. All right, questions on that? That's a really tough term. I don't know how you're going to put it on the exam. Does it kind of make sense? You see why you need to write your answer right after the class and not wait right before the exam? Because this is, what if I ask you this in the hall next Tuesday? You're going to be able to rattle it off, you think? It's a pretty tough concept. I love it because it shows you some of the complexity of finance. So the degree of optionality bond can be seen in its convexity. The more optionality it has, the more negative the convexity is going to be. callable bonds and bond with embedded options like mortgage-backed securities have low and even negative convexity. So what do you do here? So this is the strategy. Remember, you define it. The subcategories here is positive convexity, negative convexity. Bonds without embedded options, bonds with embedded options. There's really only two groups. So here, let me blow your mind on this. I don't know why I'm getting this stuff down here, but let me try it again. Yeah, I don't know why won't this disappear? I don't know why. So if you expect in the future interest rates to be more volatile, you do not want mortgage-backed securities. All right. Why? Because you're getting paid a premium, and that premium you're getting paid, so you're essentially selling this option to this person. That premium becomes much more valuable to the person you're selling it to when interest rates are volatile and much more harmful to you. So let me throw some terms out to you. If you can figure out how to do this in an interview, you'll get the job for sure, because I'm throwing out like some really hard jargon. If you expect interest rates to be volatile, you want to do what I call is buy convexity. That sounds really cool, but essentially all that means is you want to buy bonds with high positive convexity, like treasuries and non-callable corporates. So you're not actually buying convexity, you're just buying bonds that have high positive convexity. Let me even blow your mind even more. You expect interest rates to become more stable. You want to sell convexity. What do I mean by that? You're not selling anything. What you're doing is you're buying mortgage-backed securities. Now, why would you do that? Well, remember that mortgage-backed securities give you an extra 0.25% return, a yield, to compensate you for that option you gave the person. If rates become really stable, they're never going to execute that option. And what do? You get to keep the 25 bips. That's all yours. So you love selling options if you know the person is never going to take the option, because you get to keep the premium, right? If you sell someone an option to buy your house, and 2 weeks later saying, "Oh, we changed our mind," do you have to give them the $1,000 back? No. They gave you $1,000. You say, "Okay, I'll hold this house until you decide." They change their mind. You get to keep the $1,000. All right. What if they give you $1,000? They have the option to buy your house at $500,000. Sorry, some spam call. So they have the option to buy your house for $500,000 next 2 weeks, and next week Tesla announces they're going to build a major plant right next to where you live, and housing prices jump up to $800,000. Are you glad you sold that option? Kind of wish you hadn't, right? The person who bought the option, pretty happy? Pretty happy. What happened? Your volatility just increased. All right. So if mortgage-backed securities are wonderful, if interest rates are really volatile and you expect them to settle down, because they're really volatile, that spread you're getting is not 25 bips, it might be 40 or 50. And if rates settle down, you get to keep all of that, you get a higher return. But the key is, if interest rates are expected to be stable, you buy the mortgage backs because it pays you that extra 25 bips. If treasuries and mortgage backs had the same yield, you would never buy the mortgage back. You would just buy the treasury. All right. The only reason you're buying the mortgage back is you're getting that extra yield because of the optionality, and you don't think they're going to execute that option. All right. And I can't show you that because I can't show you. There it is. Because you get that higher expected return to start with. You get 4.5% instead of 4.1%. So 25 bips of that is because you're giving the person the option to do something. And if you think interest rates are going to be so stable they'll never execute, then yeah, why not pick up that extra 25 bips? Okay. Let it sink in. It's a tough. You might read Wikipedia and Investopedia. You can see that they're kind of confused on this as well. So it's not easy to do. All right, before we get into credit, is it worthwhile to learn this stuff and really let it sink in? Well, so I'm going to tell you my home life, because this is a big part of my life. It's a big part of my, almost got fired over this, but so my entire knowledge of fixed income was the CFA exam, part 2 especially. And I learned all of this. I worked with actuaries. Actuaries understand this extremely well. So I learned it. I understood it. Then I was in a job, put in a job, They created this brand new department called Investment Strategy Analysis, and our job was to look at the two insurance portfolios and come up with a strategy. They pulled the head of equities. I took his job like a few years later when he retired. Head of equities. He was a stock guy. They brought Bruce over from a real estate company. He was the real estate guy, and they brought me over. I was the bond guy. I never bought a bond in my life. My entire knowledge of bonds was academic, and everybody knew that. USA had, it's crazy to even say this, USA had 70% of its portfolio was in mortgage-backed securities. Guess what my recommendation was? Anybody want to guess? 0. The investment company was irately mad. They wanted me fired. I was a peon analyst. If you walked in the department, the head of the department was a senior vice president. He had this massive office. He had an executive secretary, so he had a massive cubicle. Bruce was an executive director. He had a massive office. And I was in this little cubicle. And I was the one making all the waves. The president, I kid you not, so you have this to look forward to in your career. The president of the investment company was so mad at me, he wrote a letter, not to my boss, not to the CEO. He wrote a letter to the entire USA board of directors complaining about me wanting to get a mortgage back. My boss is like, well, if someone's going to get fired, it's going to be you, not me. So you write a letter to the board addressing his comments. Like, thanks a lot. My boss wanted nothing to do with it because he knew nothing about bonds. This is all my recommendation. The head of the investment company said, you want to buy mortgage-backed securities if you expect more volatility. Sounds the opposite of what I just told you. Where's my knowledge? It's all textbooks. So some students say textbooks don't know what they're talking about. Well, I'm going with it because that's all I know. So I'm going with textbook. So I'm thinking I'm about to get fired because this is a big battle. I'm recommending 0, and they love these things, 70%. So what saved me? Why didn't I get fired? Well, USA had just hired a new board member. He called me and said he wanted to talk to me. I'm like, you realize I'm a peon. I don't, I'm not important. He says, no, I want to talk to you. He comes in, he is bright red face. This is one of these people you can tell when they're mad. So I'm thinking, okay, I'm in a lot of trouble. He's furiously mad. He comes to my desk. They hired him because of his fixed income knowledge. They had not had a board member with a strong fixed income knowledge, and USA is almost overwhelmingly fixed income. Why is he mad? He's mad because he can't believe we have a president of the investment company that understands mortgages so badly and is putting 70%. So he's not mad at me, he's mad at the investment. So I'm like, whew. So that guy saved my job. I don't know what would happen to me if they had not hired that guy, because he's the only one there. So that saved my job. We went to 0% mortgage backs. The investment company hated my guts. You said my friends over investment company, they told me what people were saying about me over there. So I wasn't very popular. My peers, my age, were all on my side. They were like, you're stupid to take this battle alone. None of us would ever touch these guys. They're the old school. The problem was they were all trained in the 60s and 70s. No one knew about this stuff in the 60s. No one had heard of convexity duration during that time. They saw a mortgage back paying 4.5. It was very high quality. And a treasury's paying 4.10. They're like, why wouldn't we take all the extra yield? This stuff doesn't make sense to them. So the people who follow them, they're all like, yeah, it's like, duh, Ron, that's obvious. It's like, yeah, but I didn't know. I was going by the textbook. So they're all over there rooting for me without saying anything. They're very quietly rooting for me. But we sold it all. I was talking to a friend of mine just the other day. We were talking about how horrifying it would have been if we hadn't done it, because 2 years later, Standard & Poor's started downgrading any company with a significant allocation to mortgage backs. By significant, they meant any company with more than 10% mortgage back. What did USA have? 70%. So we were talking, what if S&P had come in and the head of the investment company had come in to justify that 70%? S&P would have been shocked that we had that much mortgage backs with these old school people who didn't really understand them. We were saying we would have been downgraded. How much credit I get for that? 0. So all of that, and I saved USA all this, but I didn't get any credit for it. But I was like, this is what I know. I just said what I knew. I wasn't trying to take on the president of the investment company. But textbooky stuff, it's actually pretty good. And it explains this stuff very, very well. I had the additional advantage of talking to actuaries, which I really, really trust actuaries and their knowledge. So the property and casualty company had 70%, the life insurance company had 60%. They both went to zero. The actuaries on the life insurance side hated mortgage backs. They wanted desperately to get out of them. So they were glad to get out of them. It just shows you the bond world changed dramatically in the early 80s. But there was a large group of people that their entire focus was on credit. That's all they thought about, credit and spread. So if you have a mortgage-backed security that's full faith and credit guaranteed by the government, there's no credit risk, and yet it's paying you a spread over treasuries. They're like, this is too good to be true. And it wasn't too good to be true. It was actually pretty dangerous. I could tell you more stories of things they said. It was pretty shocking. There was a point when I was in the investment company where Money Magazine came up with an article about duration. It was the front page. And those old school people didn't know the duration of their portfolios. They'd never heard of it before. My group that came with me all were trained on that, had it in college, but they didn't. So it wasn't that these guys weren't smart, weren't good people. They just missed that entire training. They weren't reading, they were staying up to date. So they became dinosaurs. I'm sure I'm a dinosaur on some things. I get really frustrated with WhatsApp and Telegram and all these other things. I can't keep track of all that kind of stuff. But the key is, how do you not become a dinosaur? Because the world is changing dramatically. So you have to find out somewhere to be constantly reading, studying. That's why I keep track with my Victory Capital people. They have this new thing called spread duration. I called my friend Brian. It's like, what's spread duration? Do y'all use this? I saw an article on it. I'm constantly asking, what's the new thing? What's the thing you're doing now? I don't want to become like those guys that were trying to get me fired, but I'm sure I am. And it's just tough to stay up. The market's changing so much. So read the textbooks and read newer textbooks and try to figure this stuff out. So important stuff. So USA, really, really important stuff. Right. Any final questions on convexity? It gets easier now. Credit's a lot easier one. This is what most people think about bonds. So can y'all name DC cut salary? Duration, convexity, credit. I heard what's the U? Non-US bonds, taxes, structure, place, yeah, structure. Some students structures for bonds, the S on stocks is style. Some students mix those up. So bonds, we call it structure. On stocks, we call it style. And they're two very, very different things. What are the subcategories on duration? Long-term, immediate, short-term. What's your strategy? Yeah, don't read it though. What do you say? Top of your head. You expect interest rates to rise. Short duration, expect interest rates to fall. Lengthen duration. Convexity. What is convexity? We want to ask that one. That's pretty tough. But what are the two categories? Positive convexity, negative convexity, no embedded options, embedded options. If you expect interest rates to become more volatile, what do? Buy convexity, or you buy bonds without embedded options. You expect interest rates to become more stable. Sell convexity, or really means buy mortgage backs. All right, that's question 2 on the exam. It's also part of 1, but that's what you're after. If you really let this sink in, and I don't mean that you can look it up, but that you know it, your advantage in interviews is huge. If Victory Capital interviews you, you've got a huge advantage because they're all fixed income. The ones that interview our students, they're fixed income. They've hired. It was interesting. They were here on Friday, and there's 3 UTSA alums sitting there, and coming from this class, and they're all doing extremely, extremely well. So this is good. No, it's a great template, DC cut side, but if you know it, not only are you in good shape, but you're probably ahead of 98, 99% of undergraduate students. This fixed income is not covered very well in undergraduate class. If you take John Tui's class, then you're even further along, although I think John Tui does spend a lot of time on credit more than the others. It's still good to understand credit. So credit is essentially asking, will the bond pay when it's due, or will they go bankrupt? plus your chance of them going bankrupt. So credit, the definition is here is your risk of default. As the notes say, see definition credit ratings below. That's in the class notes. But who are the big two credit rating agencies? You all know those two? Moody's, and which one has the big bull in New York City? Standard & Poor's. Have y'all seen the bull in New York City? And you got a picture with the bull? You have to stand in line and wait. So that's right outside at Standard & Poor's offices. Those are the two biggies. There are others, but those are the two. And you can invest in Moody's is a great company. They have quite the monopoly. After 2008, the federal government said we need more credit rating agencies, but they just didn't show up because Moody's and S&P have so much data, so much reputation. They really have a corner on that market. You could work for these firms. They're tough jobs, but boy, they look great on the resume. They're scary jobs. The first job I had in finance, I worked with Lisa. We had a great working. I was still great friends with her and her husband today. She went from UTSA straight to Standard & Poor's. So I went and visited her and was like, what was the training? She was like, what training? So she walked into the office. Her predecessor left a 10-foot stack of paper unorganized. Like, here's your office. Here's your companies. You're going to rate them. Goodbye. Oh, if you have any questions, the Coke machine's down the hall. That's the only question I'm going to answer. That's all they gave her. She sat down and had to figure out what to do. She analyzed the company. She did her analysis. She's like, I'm ready to publish my analysis. And analysis, like, I publish it. It's like, is someone going to edit it or look at it and read it? No, just publish it. So she was shocked. I don't think I could do that. It was pretty scary. She's very, very smart and came in and was able to do it. She now moved on to a much bigger job, but yeah, that's how she started in New York. Her husband went up there to start a hedge fund. She went up with him, got a job at Standard & Poor's. We both analyzed insurance companies, so she went as insurance analyst. But scary jobs. But boy, if your gut can take it, your stress level can take it. 2 years of that, and you're set for life. Any firm's going to hire you after that. So that's what these credit rating agencies do. The credit ratings are AAA. That's the highest. There is no AAA plus. Standard & Poor's is 3 capital letters. Moody's is the capital A and 2 small A's, but they're both AA. The next one down is AA plus or AA1. S&P is 2 capital A's and a plus sign. Moody's is a capital A, small a, and a 1. So that's how you distinguish them. S&P is all capital letters. Moody's is 1 capital letter and small letters, and in 1s, 2s, and 3s. S&P is plus, no plus, and minus. So high quality is AAA, AA, and single A. Medium quality is triple B, and then low quality is everything below triple B. So double B, single B, triple C, double C, single C, and then D. And just think of D means they're in default. Single C means they're about to be in default. They're on the verge of it. So double B is not too bad. Double B bond is known as junk bonds. We'll look at some of these definitions. So junk bonds start at double B, but most double B bond has a good, I don't know, 20-30% chance of defaulting in the next 10 years, but it has a good 70-80% chance of making it. So double B is not a bad. There's a lot of double B bonds that are perfectly fine. I go to Costa Rica a lot, and I was shocked looking at Costa Rica. Its government debt is really low rated. I think it's single B, or last time I looked, B2. That's pretty low, right? You have triple B as intermediate, as medium. Double B is the top part of the junk. Single B, you're getting close to triple C. Once you get down to triple C, those that start with a C, over half of them are going to default in the next 10 years. So there's a pretty high probability. Why is Costa Rica's debt so lowly rated? You have to kind of see. You can look at Puerto Rico to talk about an area that got hit by Maria. Has had some serious issues. So is that a low rating? Pretty low rating. kind of understandable, right? They got hit with everything. It was interesting watching Puerto Rican debt. When Maria hit, their debt prices fell dramatically. And then President Trump went to Puerto Rico and said the worst possible things he could say, and the debt dropped another 20%. That's when he said, we're not bailing you out, you're on your own. And I don't know if y'all remember, that's when he threw paper towels at them. But he made it really clear, we're not bailing you out, and the bond market just tanked. So we had Hurricane Maria and then Hurricane Trump, and the bonds just fell like 80%. You can't blame them for having a hurricane, but they weren't in great shape to get into that. What do you think Canada would be? 1A, you think? What's the US? So US is interesting. Let's see if so it's interesting because Standard & Poor's actually downgraded the US government to AA. Everybody knows they're AAA. I mean, it was pretty funny because San Antonio at that time was AAA, and so San Antonio city government was saying we're higher rated than the US government. Not really. Why did they downgrade them to AA? Well, that was during the debt ceiling crisis. And S&P talks about ratings the ability and the willingness to pay. They were saying, obviously, the US has the ability to pay, but if Congress says we're not going to pay our debt because of the debt ceiling, they don't have the willingness. So Standard & Poor's, I don't think Moody's did, but Standard & Poor's did downgrade US debt to AA. So they don't even show it. They don't even show it in here. And I can't read that part. What do you think about the UK then? Should be AAA, right? AA, so they're AA. They're not AAA, but they're highly rated. So you can put other countries in there and look at their credit ratings. So countries are rated, individual corporations are rated. Their debt, USAA was AAA for the longest time, but you can't be AAA if you own a bank. Banks really, I keep wondering why USA hasn't sold off its bank, spun it off, because that bank is causing a lot of trouble. But it hurts them on the credit ratings. I don't know what their rating is today, but it's definitely not AAA anymore. There's very few. Well, let's see. What is it? Johnson & Johnson, Moody's. I mean, Microsoft. Johnson & Johnson, Microsoft, the two I can think of. Well, that looks about it. Microsoft, they just have so much cash. They don't borrow money because they need money. They have like $100 billion in cash. They're borrowing money because they're trying to avoid taxes in Europe and those kind of things. And so they're just borrowing money to avoid having to bring money back to the US. And then Johnson just very high. There used to be a lot more AAA rated companies. So there's been a pretty massive downgrade overall. There are a lot of AA companies out there now. And there's a lot of free stuff on ratings. Here's some AA's. Apple, I don't know why Apple's not AAA. Another firm with like $150 billion in cash and very little debt. But a lot of AA's, single A's. This is a pretty good website. A lot of single A's. Triple B's, a whole lot of triple. There's Walt Disney, Triple B, Verizon, Wells Fargo, a lot of Triple B's. Whose rating is this? Is that S&P or Moody's? It's all caps with pluses and minuses. Yeah, that's Standard & Poor's. So high quality are the A's, medium quality are all those Triple B's, which is the bulk of them, and then below investment grade is everything below Triple B. Although a double B is much stronger than a C. So you have governments and sovereigns. They are different. The U.S. government can print their own money. You don't generally have a lot of problems repaying your debt if you can print money in your basement. The U.S. government can print money. So they should be AAA if you can print money. The problem is if you print too much money, you have inflationary, you can have all kinds of serious problems. But the US government can print its own money. Then you have very, very high quality AAA, AA, and single A. These will have, now be careful. Remember, we talked about, do you want to lengthen or shorten duration? When it comes to spread, we talk about narrow and wide. Right? Again, I don't know who picked those words, but on duration, you either shorten the duration or lengthen duration. On spreads, they either narrow or wide. Are they either narrow or they widen? Okay, so someone picked those words. The spread is how much the bond is paying over the treasury. So the government is the risk-free, and the spreads is how much you're making over that government rate. All right, we can look at some numbers here. We got a few minutes here, so let me. We did this October last year, so it's a little old, but it's good. So AAA, the current spread on AAA back of October was what? What's that, 0.19? 190 basis points, 19 basis points, 1.9 basis points. What is that? 19 basis points, 19 bips. So if the 10-year is paying 4%, the AAA is going to pay you 4.19. What's the probability a AAA bond will default in the next 10 years? Not zero, but it's pretty low, like 1%, pretty low. The AA pays you 36 now, but look historically, it's paid 82. So spreads, last October, spreads were very wide, narrow or wide? Very, very narrow. Single A, historically it paid you 120 basis points. Last October was only 72. Even worse, triple B, they used to pay 176, now only paying 106. And high yield, I don't know who's buying high yield. They used to pay 488 bips, now they're only paying 282. I would not touch high yield right now. Anything, it just doesn't make sense. I was loading up on high yield at the end of 2008. Their spread then was 1,800 basis points. The guy who ran our high yield fund, Matt, he was like, yep, their bonds are priced to make more than their stocks. And this is like, why would you ever buy their stock? Just buy their bond. You're getting 18% return by buying their bonds. So I loaded up, and sure enough, high yield bonds were up 70% in 2009. The same as the stock market, but the stock market went up like this. High yield bonds went up in a straight line. It was like 70%, the easiest 70% I've ever made. It was like amazing. But today, I mean, look at that difference. So this is back in 2008. Their lowest ever was back in June of 2021 before the big blow up in 2022. And it's just really low. You can see the typical range. So right now, you're not getting paid very much for credit risk. That's why I've been looking at treasuries. I've been buying treasuries this year just because it's like they're very liquid, they're very easy to buy, they have good yields. I have looked at CDs. CDs I don't like as much, but I'll occasionally find a really good CD. Right now, you can probably, because CDs are essentially AAA rated because they're backed by the US federal government. And if you're getting 30 basis points from the CD, why not get the extra, 11 basis points? But that's where we are today. Here's bond spreads. Well, let me show you with 2008. Can y'all see 2008 at all? Was 2008 noticeable to bond investors, do you think? Yeah, they were freaking out. John Spear just retired from Victory. He was at USA. He and I worked together, and I saw Donna on Friday. I should have those two come in and talk about 2008 because poor John. I used to tell people, you see John in the hall, give him a hug because he was having a horrible year. It wasn't because he messed up; it's everybody was having a horrible year. Like the poor guy, it was really pretty tough. And then he had like the most incredible year in 2009. So bonds sell off here and they come back. Even high quality bonds like AAAs, they just were having a horrible time. So I went and I did an analysis. How bad was 2008 versus the Great Depression for bond investors? And 2008 was worse. If you look at the difference in how corporate bonds did versus treasuries, 2008 was the worst. Treasuries were up a bunch, 25, 30%. Corporate bonds were down 15, 25%. They weren't that big of that wasn't that big of a difference in the Great Depression. So 2008 was a horrible year for bonds. You'll notice anytime we have a recession, what do spreads do in recessions? They widen. There's a chance someone's going to default is going to be higher. I can't remember what I put out there on Canvas. I'll have to look for it. But Standard & Poor's and Moody's, they do credit default or credit spread historical papers, and they're really good papers. If I were interviewing with Victory Capital, I'd be reading that paper before I went into the interview because it's really good information. It's hard to get your hands onto it. Let's see if I put one out there. I just can't remember. Yeah, I'll find. I found one and I'll try to put it out there. Oh, here it is. Wait, I do have it. S&P 2022 default study. You might make sure you take that and save it, because if you have an interview with a firm that does a lot of credit, a lot of corporate bonds or municipal bonds, it looks really lengthy. I forget how many pages it is. 116 pages, but it's a lot of charts. Really good charts. Really informative. You can see some of the charts just going from pages, but really good information on where are the defaults, which countries, which type of sectors, which industries, what kind of bonds are defaulting. So a lot of really rich information. So I do have that out there for you, so you can definitely read that. So we have high quality, all the A's, medium quality, and then we have junk, low quality, junk bonds, below investment grade bonds, high yield. If you're doing a mutual fund, what would you call your mutual fund? Would you call it the junk bond fund? Would you call it the below investment grade fund, or you call it the high yield fund? High yield fund. They're double B down to D. They have the widest spreads. They're known as hybrid securities because they look like both stocks and bonds. Matt, the guy who ran this fund, we used to do a lot of presentations to the UTSA wealth managers. I think he was always leery to do this, but he would compare his high yield bond fund to UTSA's balance fund. The balance fund was 60% stocks, 40% investment grade bonds. And he would graph those two together, and he would show that when you buy a high yield bond fund, it looks a lot like you're buying a 60% stock, 40% bond fund. It was pretty amazing. He also pointed out that his high yield bond fund had the same volatility, but a higher return than the 60-40 fund. And then he said, but I'm not telling you put all your money in a high yield bond fund. You'd always have that caveat, but kind of like he was saying that. So essentially he proved that a high yield bond looks like buying 60% stocks and 40% bonds. So it's kind of a hybrid in between. Preferred stocks are also in there. Preferred stocks can be high quality, medium, and low quality as well. They're hybrids. Do not think of preferred stocks as stocks. They are not stocks. They are bonds. Right? Just think of them as bonds. The reason they were created was someone thought, hey, can we borrow money but get all the tax advantages of stocks? So they created preferred stocks. And then the IRS said, no, you're not going to do that. We're going to tax them like they're bonds. And so they kind of lost that preference. But they really are bonds, kind of pretending like they're stocks to try to get better tax treatment. But they can be in all of those categories. All right, so there's your three categories. So the tactical allocation we'll do next class. You can kind of guess that. If you're expecting a recession, do you want treasuries or do you want junk bonds? Probably want treasuries. So it's pretty obvious on that. What we've got to talk about is what do treasury yields do during a recession? They usually fall. So we got two things going on in recession. You want the lengthened duration and you want to move up in quality. So we'll talk about that next class. All right, we'll stop it there.